So open that question. Yeah, I'm there. So I hope everyone is there so that we kick off from there. And I read, it says, Mafuta Limited had a deferred tax liability as at 1st of October 2018 of shillings 400 million. For the purposes of preparing the financial statements for the year ended 30th September 2019, the following additional information is available. You will just read, then you become tired for no reason. So what you do, go to required, because they're not related, so there is no need of reading all that stuff. So required Roman 1, the relevant temporary differences. So let's have our format, even the exam, that is the approach you should give. Let's have the format. We read when we read note 1, we make the postings, because now we know what is happening. 2, like that, to Kisonga. So right there, Mafuta Limited. Temporary differences. Temporary differences. As at. Now which year is this? For the year ended, actually, this one should be for the year ended. For the year ended 30th September 2019. So right here, assets and liabilities. Assets and liabilities. Carrying amounts. So we have carrying amounts here. From the books, there will be millions. So shillings are in millions. Tax base. Tax base. Also in millions. Then temporary differences. Yeah, so how that arrangement? So we can kick off. So we read number 1. Analyze to Kisonga. So number 1 says the company has available for sale financial assets with carrying amount of 80 million. And the financial assets at fair value through profit and loss of 40 million. So there are two of them. There is available for sale, so right there, available for sale, and all we call them AFS, available for sale, and the other one is financial assets at fair value through profit and loss. So financial assets at fair value through P&L. You can write in full actually. Well, never in full. Available for sale, then financial assets at fair value through profit and loss. So we have those two. They are saying the carrying amount. So when the carrying amount has been given, please don't bring a lot of stories. So this one here, they have said the carrying amount is 80, and this other one, 40. So record those two first. Record the two first. And then they continue by saying, both financial assets had reported losses in fair value of 8 million each. Had reported. So we have already been given the book values. Then they are saying they had reported. It means we need to gross up to get the initial cost. So before losing the value, this one would have been 88 and this one was 48. So taxman, what the taxman always do, when they come for assessment, they check the initial cost. What was the original value before the loss in value? You know, some people might pretend that it had lost value, they subtract with to undercast the tax. So the taxman will always go for the cost, then we negotiate on wear and tear. In the event that wear and tear is not there, like here, there is no allowance, then the cost becomes the tax base. So there was no wear and tear. So for taxation, you gross up. You gross up. There is nothing like there was loss in value. You gross up, then we negotiate on capital allowance, the wear and tear. So temporary here, we are talking of 8. Like that. We proceed. Number 2. We proceed to number 2. Inventory. Thinking begins after you have written inventory. So inventory is shown at the lower of cost and net realizable value. Lower of cost and net realizable value. The cost is 32 million, while the net realizable value is 3120. So one of those two is the carrying amount and the other one is the tax base. So tell me, so that najua tumeshaanza kuelewa how this operates. Which one is going to be the tax base? There is the 32 and there is the 3120. Which is which? One of the two, Hilda, 3200, yes, the cost. For taxation, check the cost. If there is no capital allowance, then the cost becomes the tax base. So the book value is the net realizable, which is 3120. 3120. Then the cost is 32. That is a difference of how much? It is 80. So we are reporting temporary difference of how much? This is 80. So this is 80, which is also negative there. We proceed. Number 3, receivables. So receivables, what about it? What about the receivables? Receivables had a carrying amount of 2,000. So and a carrying amount of 2,000, you record. After making an allowance for doubtful debts of 80 million and an exchange gain of 160 million unrealized. Both allowance and exchange gains are not allowed for tax purposes. Fine. So, ebumunipatie tax days. Can you do something? How much will the tax base be? So people are differing. Brian is saying 2240. Frufosa is saying 1920. Hilda 1920. So which is which? 1920, 2240. One more. One more person. There is 1920 and there is Joy 1920. Yes, 1920 is correct. So Brian, it goes this way. The book value is 2,000. So gross back, there was doubtful debts which they are subtracted. Taxman will not allow you. So add back the 80. So when you add back the 80, this one comes to 2080. And also there is an exchange gain. You see, this is a gain. So the gain, you know, the gain, they had already utilized it. They had utilized it to, you know, doubtful debts is in quotes, that is more or less of a loss. So the loss had been subtracted, but the gain, they might have utilized it to go up. So for the gain, you subtract. If it was an exchange loss, fine, add back. But this is an exchange gain. So the exchange gain, you will subtract how much? 160. You subtract 160. That is what gives us 1920. If it was an exchange loss, then you add back because the loss they had subtracted. But this one they must have added because it's an exchange gain. So the gain was added. So you subtract it. So I hope that is clear. So this is 1920. Please show somewhere how you have gotten 1920. So the loss you add back because the loss initially had been subtracted, but the gain had been added. So subtract the loss, add back the loss, then subtract the gain. So this one comes to 80. Correct? We proceed. Number 4, trade and other payables. We are making payables, that's for the banking. So payables. What about it? Payables are stated at 36 after making a provision for discount of 40. So 36. Remember, this is a liability, so you subtract. After making a provision of 40, gross up. So this one will be 3640. So here we'll have positive 40. Minus will give us positive 40. Next, property, plant, and equipment. Property, plant, and equipment, that is PPE. What about it? Has a carrying amount of 4,800. Has a carrying amount of 4,800. And a tax base of 4. Hii imekuwa straight. So we are reporting 800. Some land and buildings were revalued upwards by 200 during the year. During, already it has been captured. Immediately you've been given the carrying amount, the revaluation is unless this was cost. If it is cost, is when you top up. But when someone has given you this was the carrying amount at the end of the year, and revaluation was during, it means it has already been adjusted prior to the end of the year. So here it goes out. Number 6, intangible assets. Intangible assets. Intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of 240 million. And a carrying amount of 240 million. This was allowed for tax purposes in full 2 years ago. But what will the tax base be? They are saying this amount was allowed for tax purposes 2 years ago. So what is the tax base? Somebody? How much will the tax base be? Tax base will be how much? 0, correct. Confirm. The whole amount was allowed, so there is no tax base. But if the book value is there, then the temporary will be there as well. But the tax base is not there. Assume tax the 30%, we are done. So in that question, the examiner only wanted the temporary differences. So this is what they will mark. This one's here. 1, 2, 3, 4, 5, 6, 7. So E8 lambda, the total. So now give me the total temporary differences. Give me the total temporary differences. The total will be how much? 1064. 1064. Positive. So that will give rise to deferred tax liability. Therefore, deferred tax liability is equals to 1064 times 30%. What do you get? 1064 times 30%. You are getting a deferred tax of how much? $319.2. $319.2 million. That is our deferred tax. Let's go to Roman 2 of the question. Let us go to the Roman 2 of the question. Roman 2 of the question. Journal entries. Niliwaambia jana hii mambo ya journals unaipenda. Journal entries to record changes in deferred tax. So before we journalize, let's have deferred tax account. When you have deferred tax account, it will be very easy for us to come up with the journals. So let's have deferred tax account, then we do the journals. So deferred tax account. Deferred tax account. Deferred tax account. Just rough. It was not asked to just rough. So deferred tax account, balance brought down, the opening balance. Balance brought down. Balance brought down. Where the question started. I'm seeing 400 million. There is 400, the opening. Then closing, is the one which we have just calculated here, the 319.2. So that is the balance carried down. So carried down is 319.2. However, whenever I know in any question you're dealing with the deferred tax account, always check the revaluation issue. It normally brings issue up for deferred tax. So there were revaluation, actually 3 of them. Number 1, note number 5. Check note 5. The last bit of note 5. They said some land and buildings were revalued upwards by 200. That 200 is part of this 48. So it has been taxed here. But we have to eliminate it to know what will go to P&L. So that was one revaluation. Then the other revaluations are in note 1. Check note 1. The company is available for sale financial assets with a carrying amount of 80 and financial assets at fair value through profit and loss of 40. Both financial assets had reported losses in fair value of 8 million. So an asset losing value, that is more or less of revaluation loss. So revaluation, you say here revaluation, 30% in brackets, we had 200, which is 200 minus 8 minus 8. In note 1, there was a loss. There was a loss of 88 for those 2 assets. There was loss in value of 88. While this one was a revaluation gain. Another student at a credit will gain 30% of 200, then this side 30% of 1688. That is still okay. But now if we have revaluation gain and loss, you can just net out the 2 instead of having them separated. But ideally, the losses should be debited in this account, while the gains is the one we need to credit. But now you see the gain is more than the losses, so you can net the position, then you give us one figure. How much will you get? How much will you get? $55.2. So this is 55.2. So the balancing figure will go to P&L. So it is balancing this side. So this is deferred tax income. So P&L, balancing figure, BF. How much? The balancing figure there. $136. 136. Thank you. So we can have the journals, the journal entries, which is the required Roman 2. So Roman 2 of the question. This one was just a working. So Roman 2, journal entries. Journal entries. So journal entries, you just check the deferred tax account, how it is appearing. So to record the changes. So changes means how it came from 400 to 319. So what made it to come from 400 to 319 are these 2. So these are what you take to the journals. Those 2, those are what you need to consider for journal purposes. So you can start with any, let me start with the evaluation. So for journals, we just say DR, CR, of course, shillings are in millions. You tell us which account to debit and which one to credit. So we have credited the deferred tax account with revaluation. So the corresponding debit entry will be the revaluation account. So debit revaluation because you have credited deferred tax. So revaluation reserve. Revaluation reserve account will be debited with 55.2 because we have credited deferred tax account with 55.2. You can give a small narration by saying, to record deferred tax on revaluation. To record deferred tax on revaluation. Mtu mwenye ako na syllabus ya FR ya CASNEP, hebu itafuta niwekee, there's something I would want you to check for me there. Kama unaibu angalia kama uko na ile course outline for FR. Whoever gets, you are going to tell me something in the next few. Then we record this other one. I've debited deferred tax with the profit account. So the corresponding is to credits P&L. So we have debited deferred tax account with 136. So I will credit P&L, profit and loss, also with 136. 136. Then you say to record deferred tax. I don't know that to be specific, but this is the deferred tax income. It's a decrease in provision. So you can be specific. Open. If you want to leave it open, just say to record deferred tax for the year. But I would recommend that whatever my income or expense, just say to record deferred tax for the year. Full stop. Record deferred tax for the year. That is how that question was to be solved. Then inaweza kuwa na hiyo course outline ama the CASNEP syllabus itself. For FR, there's something I want to financial reporting, advanced financial reporting analysis. There is something I want to pinpoint there to bring to your attention. Who can be having it somewhere? What I put it? Okay, it seems ikombali. But when you get to that syllabus, when they did the review, there is something they added in this topic, which was not there before. They are saying right now, we also consider, so thank you, Kelvin. So Kelvin has shared it here. So let me see if I can open and screen share. Kelvin, advanced financial reporting. So now let me see. Go to. Just a minute, I open it. There is something in the letter Apple, which I must be very keen on. Can't minimize. So screen share. This should be 100%. Yeah, so I'm sharing the screen for that course outline or the syllabus itself. So when you check What deferred tax? Deferred tax is in topic 1. Kindly check that topic 1. They are saying that is 1.3, topic 1. Deferred tax in bracket with group aspects. That is what what was not there initially. The word with the group aspects. So, so thank you. That's what I wanted to bring. They are currently requesting that we try to do deferred tax in the perspective of group. Even if you have not done group accounting, kila mtu mwenye hapa alipitia group accounting section 3. Hata kama ulipita kimungu, at least nikisema parent company and subsidiary, you have knowledge about it. So, niandikia hapo chini, deferred tax with group aspects. That is the new area. Deferred tax with group aspects. Group aspects. With group aspects. Deferred tax with group aspects. So for those who are joining now, we are done with the first question. We want to go to the next one, but we are writing something small. So we are saying deferred tax with group aspects. With the group aspects. So right there, I'm saying this involves computation of deferred tax. Involves computation of deferred tax. Computation of deferred tax for parent company, and its subsidiaries. Taking into consideration the unrealized profits. The unrealized profits and unused tax losses and credits. Unrealized profits and unused tax losses and credits for the group. Full stop. Hata kuna maneno mingi. Tangu walete hiyo kitu walileta, I think ni kwa pilot paper kama ilikuwa sitting. September 2021. So what you need to know, deferred tax group aspect is whereby you try to compute deferred tax for a group of entities, that is parent and the subsidiaries, focusing majorly on the unrealized profits, the tax losses, and the utilized credits. I think when we do a question, it can come out clear. Let's go to 2021, September. Let's meet there. September 2021. September 2021, there was a question. That is the only time walitushtua na swali kama hiyo. September 2021. Why am I not getting it? Yeah, I got it. September 2021, question 3A. Yeah. I hope everyone is there. I hope everyone is there. And now allow me to read. Allow me to read. History of Afra. With reference to deferred tax, differentiate between permanent differences and temporary differences. Format. Hiyo mko nayo hapo kwa notes niliwapatia. I gave you the definition of temporary differences. Temporary hata unaionea tu hapa kwa hii tunafanya. It's the difference between the carrying amount of an asset or liability and its tax base. Permanent, the difference between the accounting profits and the taxable profits during a given financial period. So hiyo utafuta hapo kwa notes. So this is Roman 2. Huruma Limited, a public limited company, has a portfolio of investments, including various subsidiaries, and also undertakes various projects varying from debt factoring to investment in property and commodities. Okay. The following information was extracted from the group financial statement relating to the deferred tax provision for the year ended 31st March 2021. Of course, nilisema kuna haja ya kusoma hiyo story yote. It will be wasting time. Where huko kwa required, we check what they want, we can have our schedule, then we start posting. So required, determine the deferred tax asset or liability for Huruma Group. Huruma Group as at 31st March 2021 in conformity with IS number 12 of income taxes. Determine deferred tax asset or liability. So for you to determine the deferred tax, of course, you must get the temporary differences first. So let's have our schedule. We get the temporary, then we can calculate those deferred taxes. So have there, Huruma Group. So this is September 2021. Question 3A. So A2, Huruma Group. Huruma Group. Deferred tax. Deferred tax computation. Deferred tax computation as at 31st March 2021. Correct. So you'll have here assets and liabilities. Then carrying amounts. Carrying amounts. Shillings are in million. Tax base. Shillings are in millions. Temporary differences. Shillings are in millions. So have that. Once we collect all the temporary, then we are good to go. Haya, we kick off. We kick off. So number one, Huruma Limited acquired controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. The fair value of the assets and liabilities acquired were considered to be equal to their carrying amounts, with the exemption of freehold property, which had a fair value of 256 million and a tax base of 248. The directors of Huruma Limited have no intention of selling the property. So freehold property. Freehold property. So the fair value, the market value now becomes the book value. Because actually, immediately you have fair value and carrying amount, though they never mention the carrying amount. When you have carrying amount and the market value always takes over, supersedes the book value, becomes now the true value of the asset. So fair value becomes the book value, which is 256. And the tax base is 248. Therefore, the temporary difference for the group there should be 8. That one there. Let's go to number 2. Let's go to number 2. Number 2, during the year ended 31st March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary. So among themselves, there was sale of goods worth 48 million. Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in the inventory of Wingu Limited as at 31st March 2021. Okay, so you come here and say inventory. So what is the carrying amount? What will be the book value of the remaining stock at the end of the year? There are some stock they sold to one of the subsidiaries, and I don't know there is some which remained unsold. So what will be the book value of the remaining stock? Can you try? There is no harm in trying. Trying is free. Try out. What will be the book value of the remaining stock? Hey, nobody. Inventory waliuza at a price of 48. Najua watu wako na answers na wataki kusema, wanangoja mtu wa kwanza aseme. They sold at 48 and made a profit of 16 on the transaction. 40% of these goods were held in the inventory of Wingu Limited. Hiyo lazima mnipe. Haya. Hizo answers zimeanza kukuja. Let me check. There is Joshua your 32. Joshua has 32. Caro has 12.8. Brian has 19.2. Massive 12.8, Hilda 12.8, Mwende 12.8. How wanapeana 12.8? How did you calculate? Can you show us just how you are getting the 12.8? Brian, I know how you are getting the 19.2, which I don't dispute. So our Dominica 12.8. What procedure did you follow? Let me also counter check, which is correct. Your computation. So this was 48. Then what remained in the store? Yes, 12.8 should be the correct answer. 12.8 should be the correct answer. This way, I don't know which the people are having so many directions. Kuna wenye wanakonda kwanza to 40, Carol, unafika kwa 32, 40%, 48. So, fine. Number one, it will be this way. They sold at 48 at a profit of 16. We are not supposed to record stock profit inclusive. So you will take 48 minus 16. It is 48 minus 16. 16 is the minus 16 or minus 32. Which one are we doing? No, is that going to give us the, yes, because stock in any accounting, stock should be recorded at the level of cost. We don't record stock at profit. So take 48 minus 16, which comes to 32. However, so 32 is what we were supposed to record here. But the examiner said 40% of the goods were held. It means they sold 60%. So what is remaining in the store is 32 times 40%. So 32 by 40, 32 by 40 is what gives us 12.8. 12.8 million. Brian, the 19, you gave us 19.2. That is also, I'm going to show you, it is also good. So this is 12.8 million. That is what remained in the stock. We don't record stock at a profit. We don't record stock at a profit. But taxman is coming. Taxman anakuja, anataka tax base. So what will be your tax base? Anyway, the tax base, Brian is, I think we'll end up the other way around. Tax base is the one which should be 19.2. So Brian, tell us how you got 19.2. How did you, I want to see whether you followed the right channel. Ama ulifika hapo kimungumungu. Yoso atuwe kwa nini mmekimbilia hiyo? Yes, unaona mmedifa na nani? Hey, watu wako na asasi yao 48 by 40%. Then Joshua there ako na 48 minus 60. Hatuwezi gram times 60%. Brian here ako na 48. Okay. Do this, get for me. And so this is the cost. This is the cost of the remaining stock. So get for me the unrealized profits. Unrealized profits. So unrealized profits will be 16 over 48 because they say they sold it at a profit of 16. So you take the profit margin. Profit margin is the profit over the sales value. So it's 16 over 48 times the goods which remained in the store. The goods which remained in the store is 40% of that 48. How much is that unrealized profit? That is what you should do first. So it's 16 divided by 48 times 40 times 48. That one gives you a realized profit of 6.4. So unrealized profit 6.4. So taxman akikuja, when taxman comes, he anataka the original value before you deduct it, because you know the 12.8 is the cost. We took the same value 48 minus profit. We got 32, which is the cost. Then 32, what has remained in the store is 40% of 32, which is 12.8. For taxation purposes, I will gross up because people will be subtracting unrealized profit to understate tax. So I will take the tax base will be the cost of the stock in the store plus the unrealized profit of 6.4. That should give you your 19.2. But now, for exam, whichever way you interpreted it, nimeona watu wako na styles mingi. 60% of 48 minus 16, 40% of 48, no problem. Examiner bora upatie the correct answer, they will not have any problem. So that is 19.2. But the rationale behind it, you need to get the cost, then add back the unrealized profit. For tax, you're not supposed to subtract the unrealized profit. You are not. People will subtract so that they evade tax. So you add it back, get the cost of the stock, then add back the unrealized profit. So that is why I was keen to determine, first of all, the unrealized profit. To get unrealized profit, you take the profit margin. Profit margin is profit over the sales value. Profit was 16 over 48 times the goods which remained unsold. 40% of the 48, we get 6.4. Then now you gross up the cost of the remaining stock, which is 12.8 plus that one there. But in exam, whichever way, in a equifinality, equifinality means there are so many ways of killing a rat. Whichever way you fall, borrow will get exam at 19.2, they will not have any problem with you there. So here I'll report the 6.4. Correct. Well, sawa, let's go to number 3. Let's go to number 3. Your number 3 ni refu. Well, Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purposes. This investment are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss. These gains or losses are taxed when investment are sold. Correct. The gains or losses are taxed when investment are sold. Currently, the investments have a market value of 412. That is going to be the book value. The fair value is going to be the book value. So investment, the fair value always becomes the book value. That is what you need to appreciate. So that is 412. And accumulated and realized gains. Accumulated and realized gains are 64 million. Hey, what is the story again? Huruma Limited's loan assets are the carrying amount. No, that is something else. Loan asset is something else. So unrealized gains, take the 412 minus 64. You don't add, you subtract. Because they say the gains and losses are only taxed when they have been realized. So the unrealized gains, you will not tax them right now. They will be taxed. They have said they will be taxed when realized. So take 412 minus 64 to get the tax base. What is supposed to be taxed right now? They say they will be taxed when realized. Right now they are saying unrealized. So how much do you get? Here, group aspect is the story by. So subtract. They say the gains will be taxed when realized. This one they are saying it has not been realized, so it cannot be. So the amount attributable for taxing is 348. 348, giving us the 64. Then they are saying Huruma Limited loan assets. So we have loan assets. There is loan assets. Had a carrying amount of 168. The loan asset had a carrying amount of 168. After making allowance for credit loss of 32 million, based on a 12-month expected credit loss, tax relief is only available when the specific loan is written off. Gross up, take 168 plus the 32, because they had made allowance. So we go back to the original value. So the original value will be 168 plus the 32. Is that 200? That is 200, yes. So this is 200. So we'll have their negative. Number four, Huruma Limited has unrelieved trading losses. So they have trading losses of shillings 20 million as of 31st March 2021. Trading losses, get this, trading losses ni umekuwa ukireport losses before. So ukifile your returns, utakuwa na hiyo credit, that negative balance. Those are the losses. So the trading losses is always a negative tax base. That is what you need to appreciate. Credits, the tax credits and trading losses is always a negative tax base. So that's what you need to know. So they are saying they had unrelieved trading losses of 20 million. These unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and is highly expected that taxable profits will be available in the future. So this is how, when they are available, we check them by then. So you come here and say unused tax losses. So unused tax losses, that amount should always reduce the tax base. You're supposed to reduce the tax base. So the carrying amount in the books, there is nothing. They don't, all unused tax losses and credits, there is nothing like carrying amounts. Hakuna book value. That amount straight reduces the tax, your tax liability. So here we report that negative credit. I think that thing you should write somewhere. Credits, tax credits, and unused tax losses, those two, they reduce the tax base of an entity. So there is nothing like carrying amount. We don't have carrying amount for tax losses and credits. It only reduces the tax base of the entity, because ukifile returns, utafile ulipe 200 million. Now you had trading losses in the previous year, so you are allowed to reduce your tax obligation with that. So we don't have book values for unused tax losses and credits. Next, on 1st April, Huruma Limited deferred tax account had a nil balance, assume fine. So required the deferred tax liability. So give me this one here. Give me that total. So in this question, I'll tell you what are critical about it. Now I'm here to say it. But you've tried. The challenge is always on the stock. This one and the unused tax losses. Those two. So how much is the total? How much is the total? Somebody's getting how much? $13.6. Therefore, it is positive. So deferred tax liability is equals to 13.6 times 30%, giving us deferred tax of how much? 30% of 13 should be 4 point something. 4 points. 4.08. That is the deferred tax liability. So for the group aspects, what you need to know, mostly, najua group ikiwa hii haitakosa. This one for inventory. The inventory issue, what you need to know about stock. Stock in the books, in the financial statement, stock must always be recorded at the lower of cost and net realizable value. So we don't record stock at profits. So remember this stock, it was sold at a profit initially. So to get the closing inventory, take the sale value, which was 48. So let me not zero into this one here. Let me open it. Opening it means for the next questions to come, you take the total value of the inventory minus the profits. So if there were nothing which, if they never mentioned that 40% remain, then we assume the 32. If there was nothing like 40% remained in the inventory, I would have brought here 32. For example, I said 40% remained, it means they sold 60%. So you will take the 32, which is cost, times the 40% which remained in the inventory. That is 12.8. We don't record stock at profits. So you eliminate the profits, you remain with the cost. So I would have brought 32, but they said 40 is what remained. That is how we got the 12.8. Then to go to the tax base, taxmen are very rigid. You are not supposed to subtract that unrealized profits. So these people had unrealized profit. To get unrealized profit, though this one we are going to do much in group accounting. Unrealized profit, you take the profit margin. Profit margin is profit over sales. So profit was 16, sales was 48 times. So unrealized means on the remaining stock. So 40% of the 48, the whole amount. So unrealized 6.4. So taxman will want the initial value. Hakuna mambo ya subtract. So add back. Because they are subtracted, for you to get 12.8, we will push out our profit. So taxman will not allow you to subtract profit. You want to escape tax. So we added back the unrealized profit. Though people are having different versions of 60%, you know that 60%, if it can give you fine, but you know 60% is what was sold. So for taxman, like your story, take the cost plus that amount of unrealized profit which was subtracted. Then when we come to credit tax and unused tax losses, that amount of unused tax losses or the credit tax should straight away reduce the tax base of the company. So you bring it here. And there is no book value for the unused tax losses or credits. It's always zero. I want the book value. Just as simple as that. So my main issue was, if you get this unrealized profit and the rest, just know that is deferred tax for group aspect. It is new in the syllabus, it was not there. And that is the only question we have touching on group. At this point, allow me only one more question to finish deferred tax. There is a question we did when we were starting this topic, the one which was called sophistic, the one which had the current tax. We computed the current part of it, then there was the deferred part of it which we did not cover. So I want us to go to that question. Do you need a small break, like 3 minutes? Do you need like 3 minutes break? If not, then we just continue. Vera is requesting for 5 minutes break, but fine. Let's get the question. Then then we go for the break. Let's check for that question. It's our last question. It was 2015. I can't remember which 2015, but I remember that question was 2015. So now, which 2015 was it? Which 2015 was that question? The one for sophistic, we did the current part of it. September 2015, question 3B. By extension, which page? So check for September 2015, question 3B. We take a small break. That will be our last question for deferred tax. We just go for the break. I take the break. Let's meet back at 6:50. 6:50. If I just start from deferred tax liability and Sumbua, let me just allow me to start this question afresh. I will flow very well. Instead, let's just read it afresh. If I assume we are done it, it will bring me problems in the mind. So Sophistic Limited, newly listed company, has provided the following information with regards to computation of the tax expenses for the year ended 31st May 2014. So accounting profits, depreciation, donations, amortization, capital allowances, tax, while it taxiwa 25%, I think because they were newly listed. The company has not yet determined tax expense for the year ended 31st May 2015. Additional information. By the way, something has just come up in my mind. Kama mnaweza amka hii 5:30, kwa nini basi tusiamkange hiyo 5:30 ndio wachilie by 7:30 for those who are rushing to work? Kwa nini basi tusiandiange hapo? Ama hebu think about it. We can discuss after class. Kwa nini tusianze hiyo 5:30 to 7:30? So additional information. Accounting profit for the year ended 31st May 2015 was that, while donations amounted to that. An extract of non-current assets movement schedule for the year was as follows. So we have plant and software. Each one is italetwa. Cost on 1st June 2014, as you can see. Additions during the year, accumulated depreciation, tax written down value, as you can see. Plant is depreciated at 20% per annum using the straight line method, while wear and tear allowances on plant is provided at 25% on reducing balance basis. Software development commenced in the year ended 31st May 2011 and was completed in the immediate subsequent year. The company capitalized development cost, which amounted to 9 million, and amortization commenced on 1st June 2012. Yes, 2012, using the sum of digits method over the estimated useful life of 5 years. Software development costs are allowed in full for tax purposes in the year in which they are incurred. Donations made by the company were not tax allowable. Corporate tax rate applicable for the company's earnings for the year 2015 is 30%, and the company is expected to continue generating taxable profits in the foreseeable future. Required current tax to be charged in the income statement for 2015, deferred tax liability to be reflected in the statement of financial position, then deferred tax liability account. Roman 2, deferred tax liability to be reflected in the statement of financial position as at 31st May 2014. 2014. Then deferred tax liability account for the year 2015. Correct. So let's can we just start from deferred tax? I think the current. Okay, let me hear from you. Do we start everything afresh, like current, deferred, then the deferred tax account? Or you can still recall the current. I start from Roman 2. Maoni ndio kusema. So say something there. Do we start up from the current to Kiteremka? Ama we cut, because current we had solved it somewhere, or we just cut it from deferred Roman 2 as we proceed? Which one will you connect very well? Whatever the first person says will prevail. Just for says, let's just start from Roman 2, sour. Because even you have the answers for the current tax. So right there, Sophistic Limited, deferred tax computation as at 31st May 2014. All right. So assets. Hapa kuna liabilities. There are only two assets, plant and software. So there is no liability. Liabilities where liability is not there. So assets, carrying amounts, please write in full. Shillings are in thousands. Tax base, shillings are in thousands. Temporary differences, shillings in thousands. Kindly write those initials in full. Sitaki uzoea hiyo kwa mtihani ikaleta shida kubwa.
Next.
We kick off. So we only have plant and software. So plant and software. We have those two. We have those two, plant and software. So the carrying amounts, 2014, please, we are in 2014, remember? So 2014, the cost, check additional information number 2. Check the additional information number 2. The cost was 32. To get the carrying amount, you subtract the accumulated depreciation. Accumulated depreciation was 19,200. So take 32 minus 19,200. You can show you're working somewhere in case you may forget. You give me the answer, I'll show you how to show that working. What is the difference? 32 minus 19,200. We are in 2014, so you just use those figures in note 2. What do you get? 32 minus 19,200, 12,800. You get 12,800. The book is yours, so you can just put in brackets here. 32 minus 19,200. So that you can know where the answer is coming from. So that's the book value. But taxman anakuja. Taxman will check the written down value for tax purposes. Written down value is cost minus accumulated wear and tear. But now, already we were given the tax written down value on 1st June 2014. We were given 18,500, if you can check. So for tax purposes, you will take 18,500 for plans. The tax written down value, 18,500. That is what you consider for taxation. Therefore, temporary differences, will be 12,800 minus 18,500. What do you get? What do you get? What do you get? 5,700 deductible. Deductible temporary differences. 5,700. Let's go to the software. Software, you take for the carried amount, you will take the 9 minus, you see they have said accumulated depreciation, though that's not the name, it should be accumulated wear and tear, but fine. So it is 9 minus 54. 9 minus 54. You take the cost minus that one there. What do you get? What do you get when you subtract? 36. Tax base, wameweka question mark. The tax written down value, wameweka question mark. But I can relate it. I can relate it with note 4. The last bit of note 4, we cannot read the entire note 4. The last bit of note 4. The last bit of note 4, they say software development costs are allowed in full for tax purposes in the year in which they are incurred. So when you allow in full, it means the tax base is 0. There is no tax base. You know, tax base is the amount which should be assessed for tax, but they are saying the whole amount was allowed, though there is book value. So this book value will be checked for taxation. And we are done. That is the 2014. There is nothing else. So add omissions. You are remaining with the negative what? 57 and the 36 will remain negative. How much? 21. So you have deductible temporary differences of 21. And examiner, what was the question? Check required Roman 2. Deferred tax liability to be reflected in the statement of financial position. Therefore, deferred tax assets. This is an asset. Negative, after VAT we put a negative, that is receivable. So this is an asset because it is negative. We are not paying. So deferred tax asset for 2014 is equals to 25% times the 21. Why am I using 25%? When you check where the question started, how they calculated the current tax. Check up there where the question started, that schedule, where the question started up there. The tax rate for 2014 was 25%. I think because the company was newly listed. When a company is newly listed, there is always tax benefit wanapewa kidogo. So that is why they were charging 25%. But in 2015, if you check note 6, they said now it is 30. So if at all I was dealing with 2015, I will have multiplied by 30. But 2014, the tax rate which was there was 25%. I believe it is due to the fact that the company was newly listed. So how much is the tax asset there? How much is the tax asset? 525. 525. That is our tax asset for 2015. It is tax recoverable. It is tax recoverable. All right, let's go to Roman 3 of the question. Let us go to Roman 3 of the question. Roman 3, deferred tax liability account for the year ended 31st May 2015. You know, for you to come up with deferred tax account for 2015, I must have balance brought down for 2014. So 2014 already we have. This closing figure in 2014 is going to be the brought down in 2015. But where is the carried down for 2015? So it means we must also calculate the deferred tax for 2015 is when we can come up with the account. So that this one will be the brought down, then for 2015 be the carried down, then we get the difference between the two. So let's get the deferred tax for 2015. So right there, deferred tax deferred tax 2015. This one was not required, is a working. They want the account, so this one is just a working. So 2015, I will also bring the assets. I'll bring the carrying amount. I'll bring the tax base. I'll bring the temporary differences. That one you can use the initials because it is just a working. It's a working to help us get the deferred tax for 2015 so that we can come up with their deferred tax account. So kill these two. So plant, software. Have those two. So plant last year 2015, 2014, the book value was 12.8. So to get the carrying amount, take 12.8 minus depreciation for 2015. Depreciation 2015 we got because what we did, they said in note 3, check note 3, plant is depreciated at 20% per annum using the straight line. So depreciation 2015, we took 20% of the 32 because the cost is 32. We got 20% of the 32. That one gave us how much? What did we get? We got 64. So to get the net book value for 2015, so carrying amount 2015, you will take this one here, 12,800, the closing figure for 2014 minus 64. That is what you post for 2015. You subtract that depreciation. So what do you get to that effect? What do you get to that effect? Somebody? $6,400. So this is 6,400. Tax base. Tax base is the written down value. So written down value for 2014 was 18.5. So we need to subtract. We need to subtract the wear and tear. We need to subtract the wear and tear. For tax base, you take the cost minus the wear and tear. So I'll take the 18.5 minus wear and tear for 2015. So wear and tear 2015 is equals to, wear and tear was mentioned in note number 3. Wear and tear on 25% on reducing. So reducing, you will take the 18.5. 18.5 reducing because this was the tax written down value. So 18.5 times the 25%. I think we did it, Jana. What did we get? There's a value we got there. We got how much? The 18,500 by 25. We calculated it yesterday, or you can still do it. How much? Yeah, 46.25. I remember that figure. Therefore, tax base 2015 will be the 18,500 minus 46.25. How much? 18.5 minus 46.25. Unaenda ukipunguza. Even next year hivyo tu. So 18.5 minus 46.25, 13,875. 13,875. So 6,400 minus 13, what will you get? 74, 75. Right. Let's go to the software. Software, of course, tax rate is 0. The amount was already allowed for tax purposes. So you have 0 throughout. But let's check the carrying amount of software. Software, carrying amount, you will take this one here. 36 minus amortization for 2015. So 2015, let me get amortization for 2015. 2015 amortization, they say, I don't know whether there is someone who was not there yesterday, but they said they were using the sum of digits method. So we took the cost of the software, which was 9, we multiplied by 3/15. Sum of digits, they said the useful life was 5 years. So the sum of digits was year 1 plus year 2 plus year 3 plus year 4 plus year 5, which gave us 15. Then amortization started in 2012. We are in 2015. So that one was falling here in year 3. So we took the 3/15. So this one is coming to how much? We got how much? 1,800. So this one came to 18. So to get the carrying amount of the software, for 2015, you will take this one here. You will take 36 minus, 36 is 2014. So 36 minus now 18. 36 minus 18 is another 18 here. So this is 18. Like that. Kisha, you to Malaysia. So how much is the total taxable, the total temporary differences? Temporary differences. Ukipata hiyo swali kwa mtihani upite nayo. Huh? 5675. 5675 negative. Therefore, deferred tax assets, that is also giving us deferred tax assets. Therefore, deferred tax assets is equals to 5675 times 30%. 2015 tax rate was 30, unlike 2014, which was 25. So 30% of 5625 will give you how much? So people are getting 1702.5. Also an asset. So let's come up with deferred tax account. They wanted us to come up with deferred tax account for 2015. For 2015. So all of them were deferred tax assets. So 2014, there was a deferred tax asset of 525. So you bring it down in 2015. Asset will not be on the credit, rather debit. So balance brought down is 525. Also 2015, the balance is an asset, so carried down will be on the credit. Assets are carried down on credit so that you open with them on the debit. So balance carried down 1702.5. So the increase is what we take to P&L, which will be this side. So to P&L, balance is bigger. How much? How much are we taking to the profit account? 1702.5, 1702.5. How much goes to the profit account? How much are we posting to the profit account? Thank you. 1177. Whichever that answer you got there. That is it. So I don't see anything somebody will ask you as far as that topic is concerned. Kama ni theory hizo mko nazo. Computation, even if you can't get 100%, I'm sure you can get something. You are not very, you will not be like, that topic is very difficult. That's what you can do. So for now, allow me to stop that topic at that stage. It is not the only topic. There are some other topics to be covered. So let it rest at that stage. But I want to introduce a new topic. I will want to introduce a new topic. I want to take you to IFRS number 9. So can you Google check for me? IFRS 9 is talking about what? I want to take you to IFRS 9. I want to take you to IFRS 9. IFRS 9 is on financial instruments, correct? So, topic. So financial instruments in brackets financial assets and liabilities. Right. Have that. So this is one of the topics which are very challenging. They are one of the topics also which just require the normal understanding. So you are sasa wewe ni mtu wa fara hapana. Wewe ni mtu investor. In fact, about tukue kama investors. As a related background for people to understand this thing properly. Financial instruments, these are securities, mostly in the stock market for trading purposes. Government also trade in the financial instruments. Good examples of these instruments are the bonds, are the bills, debentures, loan notes, among others. You remember when watu wakishachukua pesa yetu wanakuja wanatudanganya na kizungu mingi, a lot of English which you don't even understand. You remember the story of Eurobond. So Eurobond, the complainant was saying, the bonds were issued, the money was received, but the amount received cannot be traced. What is being seen is the interest being paid out. So government giving out bonds means this. You know, the bonds are in the custody of the central bank governor, all the bonds. And that central bank governor, remember, I've got a security of tenure. One of the reasons I've got your security is because of these bonds. If you joke with that person, he can put the entire country in a mess. And one way to mess the country is through these bonds. Historians, kuna watu wanajua hapa history vizuri sana. There is this country. Which country? There are some two countries which were messed through this. Greece, there is Greece and even Uruguay. Uruguay is even the other day up around 2013-14, I'm not sure. What the central governor did, Ali issue bonds to the public. You know, when you issue bond, though you call it in finance, you call it bond flotation. When you float the bond to the public, what happens? The public comes for the certificates. So the certificates will just look like this. So for example, government of Kenya, for example, 10%, 3 years, shillings, 5 million bond. That is just an example. So the central government, so when they want to borrow, when the government wants to borrow locally or even internationally through this, what they do, they issue these certificates to the public. So you are the public. You take your 5 million there, they give you the certificates. So you are the investor. Government is the borrower. So the borrower will have two obligations. One, to be paying the annual interest and to repay the principal amount upon maturity. So maturity is the 3 years. The annual interest is the 10%. Then the principal value is the 5 million. So upon the lapse of year 3, they need to refund you back your 5 million. You having received interest of 10% for the 3-year period. So those people who are complaining of the Eurobond, I don't know whether these bonds were floated in Europe. I don't know, or they were denominated in euros. Maybe, I don't know. This is familiar. Either they were denominated in euros, and the benefit of denominating a bond in a foreign currency is to gain on that foreign exchange issue. So either they were denominated in euros or they were floated in euro. Me, I never followed because those were mere politics. So they were complaining that the government issued these bonds, the amount which were received, because when you float them out, you're supposed to receive this principal. So mnapokea, then you start paying interest. So they were saying the amount which were received cannot be seen. Ionekani kwa vitabu for the government. The principal cannot be traced. But what is being seen is the credit amount in the cash book, the interest. Interest is being seen. So wewe umenipatia pesa, then the money which you have given me cannot be seen. What's being seen is the interest being paid out. That was their complaint. So the principal issue here is on how to account for them in the financial statements. So our main issue are going to be the three. One, the classification of these instruments, their classification, how do we measure them, and how do we recognize them in the financial statement. Those three is the classification, measurement, and recognition in the books. So allow me to tukiandika hizo notes, I'm going to waste time. So allow me to share the notes, tusome na nyinyi, tukidiscuss, tukimaliza, if time allows, we can do the relevant questions. It's also a wide area, which hata tuwezi maliza leo. It's very wide. Iko na derivatives, embedded, what, a lot of issues, but like we can try to maliza by the next class. So give me like 1 minute, I share with you the notes. So you leave a page, the relevant pages, your mtaandika baadaye. If I give you to write, you will waste a lot of time, which we don't have. So you can do something as I take the photo and share. Yeah, so I've shared some small notes there, which I want us to go through. You can write later. So you can open up. So let's go through this. It says, and I read, so we'll be discussing in what Kisonga. Financial instruments are contracts which entitles an entity or a party to receive cash or equity instruments of another entity. Yes, that is the financial instrument itself. It's a contract which entitles you to receive cash or other instruments of another entity. Examples includes debentures, loan notes, bonds, among others. So we are starting with the classification of financial instruments. And for the classification, I will request, let me just request randomly. I can request Kelvin. Kelvin, maybe you can unmute. I want you to read for us May 2019 question 4A. We are starting with classification, and I think that is on that. May 2019 question 4A. So Kelvin, you will unmute. Let me allow you to unmute. So unmute, then read for us that question. May 2019, question 4A. Or I can give who is near Kelvin, Joyce near Kelvin in the Zoom there. So either Joy or Kelvin, whoever gets it first, you can unmute and read for us. So where is May 2019? Page 78. I'll be there. Amma Joseph, you can read for us to avoid time wastage. Allow you to unmute. Kwani siku allow participants, yes. I've allowed.
Question 4A. Briefly explain the various classifications of financial instruments as per IFRS 9 financial instruments. 6 marks.
Thank you. Thank you. So it's about classification. I told you our main focus is going to be classification, measurement, and recognition. That is our main area of focus. Measurement and recognition. So this standard, I can't recall, but I think it changed in 2018. We used to have 4 classes of financial instruments: the receivables, the held to maturity, among others. But with the new standard, that is IFRS number 9, financial instruments are only classified into 2 categories. Only two. Only 2. So we used to have 4 initially, but currently they are only classified into 2 categories in the new standard. That is what you need to know. So in the scope of the old standard was IS 39, I've recalled. The old standard was IS 39, where they were classified into 2 categories. But currently, we only classify them into two categories. That is, we go back to the notes now, under classification. So we have financial assets at fair value through profit, stock, loss. These are short-term financial instruments. They are recognized at their fair value. Any gain or loss on their fair value is recognized in the statement of profit or loss. Then we have financial assets at fair value through other comprehensive income. These are long-term financial instruments. They are recognized in other comprehensive income, and they are measured at amortized cost. In the old classification, there was even the amortization classification. So currently, we only have 2 in the new standard. In the old standard, I must make it clear, because you might be reading some textbooks and the rest. They used to classify them into 4: the fair value, the amortized, the loans and receivables, then there was held to maturity. That was the old standard in IS number 39. In the current standard IFRS 9, we only classify financial instruments into two categories. There are those at fair value through profit and loss. Profit and loss is only 1 year. So we tend to deem that they are short term. Na msifikirie sana, angalia kama money markets. Look at the treasury bills. Those are short term. They are financial instruments which can be classified through profit and loss because they are only covered, mostly they just go for a year. Money market, you can even withdraw at any time. But there are some bonds which are going for long term. Unasikia 10 years bond, 30 years, I don't know how many years. If the bond is meant to go for a long term, then we classify them through other comprehensive income. So classification are only those two in the new standard. Take that into consideration. Recognition down there, we are proceeding with the notes. An entity should recognize a financial instrument when it becomes a party to the contractual provisions related to the instrument. So the examiner can ask you, when should an entity recognize a financial instrument in the financial statement? So we recognize them immediately the entity becomes a party to the provisions of that instrument. Initial measurement. Initially, so initial means when you become the party, what value should you recognize? So initially, all financial instruments are measured and recognized at their fair value. So regardless of the classification, whether short-term or long-term, at the initial stage, all of them must be measured at fair value, at their market value. Remember, in the stock market, we do, why is that not clear? It's clear. In the stock market, we have the bulls. We normally have the bulls and the what? In the stock market, we do have the bulls and, yes, the center and the bears. So in the stock market, we do have the bulls and the bears. So the bull, there is fluctuation. Bulls is when the security prices demand you. Increase in security prices is called the bulls, while bears is when now they become affordable. So there is always that fluctuation. So when you become a party to an instrument, that value, whether it is a bear or a bull, that value on that date is what you need to recognize in the financial statement. That is what you recognize. Whether it is going to be long or short term, initially, all of them must be measured at fair value. Subsequent measurement. So subsequent in the years to come. So in the subsequent periods, financial instruments are measured based on their nature of classification. So in the periods to come, it will now depend. Was it short term or was it long term? Those classified through profit and loss should be measured at fair value. While those classified through other comprehensive income should be measured at amortized cost. So hapo ndio zinaachana. The short-term ones, the ones which are normally classified through profit and loss, they are short-term, ni ya mwaka tu. So initially, fair value. Subsequent, fair value. Because they are normally held for trading purposes. Mtu anakaa tu anaangalia price imeenda wapi, ni bull, anauza. So the ones which are short-term through profit and loss, initially, fair value, subsequently, fair value. The ones which are long-term are the ones we call other comprehensive. We classify them through other comprehensive income. Initially, fair value. Subsequently, amortized costs. So the question you need to ask me, what is this amortized cost? We go back to our notes. Amortized cost is the reduced value of the instrument, having taken into consideration the finance cost and the amount paid. That is the interest. So what happens? There is what we call the market capitalization. When you give me instrument now, surely, umenipatia instrument sai, na nikakupatia 3 million, ama 5 million. Then you want to return it after 3 years. Then you tell me, I'll be paying you interest. As time goes by, inflation inapanda, mafuta inapanda. Inflation ni mafuta peke yake. So inflation is going up. there is the credit risk adjustment and all that. So the value of the bond should always be increased with what we call finance cost. Finance cost is the base interest rate of the central bank. Central bank has their own lending rates, and that is what we call finance cost. So immediately the bonds have been issued, there should always be that capitalization using the finance cost, which is the central bank base lending rates. So to get the amortized cost, you'll say it is 5 million plus the cost of financing, maybe 0.6 minus the actual interest, which has been paid 0.2. So the value of the outstanding is 5.04. So the 5.04 here is the amortized cost. So amortized cost is when you have increased the value of the bond with the market capitalization minus the actual interest which has been paid. So as time goes by, because this is a long-term bond, so you will be increasing, then you reduce with the interest, increase, reduce with interest as time goes by. So that is called amortization. So amortization is that reduction in value of the bond as time goes by. So the examiner can ask you, explain how financial instruments under IFRS 9 should be measured in the initial stages and in the subsequent periods. So initially, all of them are measured at market value, which is fair value. However, in the subsequent, it depends now with the classification. Those classified through profit and loss will continue to be measured at fair value. Those classified under other comprehensive will be measured at amortized cost. And amortization utakuwa unapunguza as time goes by. Correct. We proceed. There is what we call D, the recognition of financial instruments. This is the removal of a previously recognized financial instrument from financial statements. So you are already captured. And by the way, the capturing is two-way. The issuer of the bond and the acquirer. So acquirer is the investor. So kama wewe ukienda uchukue your bond, you are an investor. So you need to recognize an asset because it's an investment. Then the government who has given you the bond, they need to recognize a liability because they have borrowed from you. So when you recognize a liability or an asset, then you remove it from the books. That is called the recognition. That one, nobody will ask you what is the recognition. What you can be asked, the circumstances or conditions under which an entity should recognize a financial instrument from the books. Down there, we proceed with the notes. Circumstances for the recognition. Number one, upon expiry of the contract period. So your 3 year application, I return that certificate, they give me back my money. That is expiry. When the instrument has legally been transferred to a third party, so when you transfer to a third party, I remove it from my financial statement. Then when the entity has been prohibited from selling or pledging the initial asset. So kama government wakona bond na umekuwa restricted not to, na ulikuwa umeshapeana, hakuna, you just move it from the books. Then when the entity has no further obligation to make payments in relation to the concerned instrument. Mostly that one you still, okay, it can be other factors, but mostly upon expiry. Ama maybe kuna quote or something. So when there is no obligation again to make payments or to receive, no obligation to receive or obligation to pay or right to receive any contractual cash flows on the instrument, then there is no need of having it in the financial statement. So you can be asked by examiner, that one I know, circumstances under which a financial instrument may be recognized upon expiry, when it has been transferred to third parties, and when you have been prohibited from selling or pledging the instrument, then when you don't have any obligation to make payments in relation to the instrument. Then we have what is called reclassification of financial instruments. So reclassification, before we read, initially you are classified it as financial instrument through profit and loss. Then now you want to change. It was short term, now you want to take it to other comprehensive, long term. So that one means reclassification. That is what we call reclassification. You move it from long term to short term or short term to long term. That is what we call reclassification. So this arises when an entity reclassifies an instrument that had initially been classified as either short term or long term in nature. This can only take place when the entity changes its business model of handling the financial instrument. Hapo haina maneno mingi. Main concerns. Hapa kwa main concerns ndio our key area. Main concerns which we are going to check: determination of equity components in an instrument. Yeah, that is very critical for us. Then number 2, determination of the value of a bond in case it is to be held at amortized cost for long term. So number 2, we are going to check how to amortize long-term instruments, and we only amortize those which are at other comprehensive. And also determination of equity components. Bonds normally have equity elements in them. So how do you determine the equity? How do you recognize them in the financial statement? So let's start with equity components. So options to equity. This is the difference between the total proceeds, borrowed funds, and the liability component, amount payable to the investor. Equity component is to be recognized separately as part of equity in the statement of financial position. So how do we calculate the equity component? You take the total proceeds minus the liability component. Liability component is the present value of the principal plus the present value of the annual interest. The examiner hawajakuwa keen on examining equity, though inakujanga as part of additional information. In which topic? Kuna topic hii inaletwanga as additional information. This we should get in group and even cash flow. But in this topic, the one they have been concentrating on highly is number 2, the determination of bond value, the amortization. So here I just have a simple illustration for equity. It will help us to get up on there. So I just have a small illustration which we are solving right now. Then I introduce the amortization part of it. So let's read this question. ABC Limited issued shillings 2 million 6% bond on 1st January 2015. The effective market interest rate for similar bonds was 10%. The bond is due to mature on 31st December 2019. Required, calculate the equity component to be recognized in the books of ABC Limited on 31st December 2015. So now, you know, equity component is a capital saving. By the way, unajua kuna watu wengine wakiona mtu anakopa wanafikiria huyo mtu akiana pesa. No. That is not the case. Some people borrow to raise capital. So unataka kusema kama Safaricom wakiissue bonds, not bonds, bonds is for government, debentures. If they give out debentures, you think they are giving out those debentures because they are in financial distress? No. They are just, is a way of raising up equity. The way I'm going to show you here. So in that question, they want us to get the equity. So let's solve this together. Equity components. So the equity component, you will take the total proceeds. How much did you borrow? So total proceeds minus the liability components. So they borrowed 2 million. How much will they pay? So the difference in you and Abaki Apple, that's a capital saving on their side. And I can bet for that. We normally, people invest in these things. I don't know whether to remain relevant in the society or what, but you cannot gain. Hakuna gain unaweza pata hapo hata kidogo. There is nothing. You cannot gain. Even those insurance, you cannot gain. You can't. Hata watu wakuambiagi, even try with money market. They will only tell you, they are very funny. They will only tell you what the interest rate which you will get. They don't even mention for you the withholding tax. You will get at this percentage. Those people will always gain due to the market capitalization. They will always gain. So these people, they borrowed 2 million. Then the amount will be redeemed in 2019. So 15, 16, 17, 18, 19, 5 years. So that bond is going for 5 good years. Yes, it's a 5-year bond. So the total proceeds, right here, total proceeds is 2 million. The total proceeds is 2 million. Now you subtract what they will pay back, which is the liability. So let liability component less the liability component. So liability components, when you issue a bond, you have 2 obligations. One, utakuwa unalipa the annual interest, that is 1. 2, you will pay the principal upon maturity. So the principal watarudisha 2 million. But now check, this 2 million will be returned when? It will be returned after 5 years. So you as finance people, you cannot just come here and say the principal refundable is 2 million. You must check the present value. So you will say present value of principal. So the principal, you will say here 2 million times 1 plus R raised per negative n. That is how we discount non-annuities because it's lump sum. So the cost of capital which is used, please get this. Tunakuwa na 2 rates. We have the contractual rate and we have the effective market rate. Effective market rate is the CBK's rate and is the one we normally use as the cost of capital for discounting purposes. So in these questions, you will be finding 2 rates. There is the rate for the normal interest, which is contractual, then there is the effective market rate. So for discounting purposes, always use the effective market rate. It was 10%. So it will be 1.1 raised to power negative 5. It's 5 years. So you are trying to get what is the value of this 2 million in 5 years to come. Can you calculate this for me, please? You start becoming mad. And imagine it's something you can do for yourself. Lakini mimi siwezi taka mfanye. Ukifanya mtakuwa stingy. You will not invest in anything. Because right now, in fact, I want to subject you. Munipatie your answer first. Give me that answer first, then I subject you to something. Thank you. 1241, bring it somewhere here, not to the far end here. 1241, 843, let's round up. 843. So unajua ukijaribu kufanya utaona the value of 2 million in 5 years to come. And it's something you can always do. Unajua watu wana, hebu check for me because siku hizi watu wako practical, CBC iko mpaka PhD, so si nyinyi peke yenu. Na unajua CBC ya Kasne but ni hiyo pepa mnaenda kufanya hapo mbele at business data analytics. Hiyo ndio CBC ya Kasne. So can you check for me on your Google platform? It's good to know. What is the CBK's lending rate as we talk today? Just check for me on your Google platform. I want us to check the CBK's lending rates. Just Google that, CBK's lending rates. I want us to know. It's also good to be more practical. Nani amepata? CBK's lending rate. Joy, 10.5%. So lending rate of CBK, as we talked right now, is 10.5%. Do you think if you enter any of these commercial banks, Upper, Equity, KCB, Cooperative Bank, any other bank in Kenya, unaweza pata loan sahi na 10.5%? Can you? You can't. So 10.5% is the market capitalization in Kenya as of today. So if you are giving out your money, your 2 million for any bond, you can discount the worst case scenario as of today. You just use this. You just take your 2 million, 1 plus R, your R is 10.5, raised by -5. You'll be able to know. But me, I discourage. If you do that, you'll never invest. So zingine unatia dunia. Don't be very thorough in everything. So here you can complain. Mtanipatia naopea 2 million mnarudishia after 5 years ikiwa na the purchasing power is 1.2. Alafu anakuambia don't worry, we'll give you interest. Our interest is 6%. So wanakuentice na interest. So you also determine present value of the annual interest. Annual interest is 6% on the principal amount. The 6% on the 2 million. That is 120. So you know at face value, we would have 120 times 5 years. 120 times 5, you know, 600. Whichever. Nasema 600 plus 2 million. Mtapata back 2.6. You can be very happy. But if we check the present value, it will be 120 times 1 minus, how do you discount for annuity? Because it is constant, 120, 120, 120. Annuities, unachukua 1 minus 1 plus R raised by -n divided by R. That is how you determine the present value for annuities. So you say 120 times 1 minus, in brackets, 1.1 raised by -5 divided by 0.1, because it is 10%, so 0.1. Nipatie hiyo figure hapa. Give me that figure. What do you get when you discount? What do you get, Hilda? 454. 454. 894. So imagine value 600 above 454. So the total obligation within the know, where was the owner? Where would have 2 million plus 600, which is 2.6. Lakini to them, they know by the time wanakulipa, it's 1.2 plus this one. So can you add for me these two? So these are the liability component. This plus this. How much? What do you get? In total? $1.2 plus that, it should be 1.6 something. 1696. 1696. 737. My friend, that is how you will lose investing in that thing for 5 years. Hata ufanye nini, hata hizo government bonds, unaona inaandikwa hapo vizuri, watu wanaongea this one looks lucrative, hakuna hivyo hapo. You will always lose. Just invest for the purposes of society. If you want to become, you are also an investor. So what you are losing as an investor is a capital gain, and that is one way of raising capital. You just give out those bonds, then by the time unarudi inflation imeenda juu, you give them at the value akuta kwa na kitu. Therefore, that saving is the equity component to the borrower. So equity component. How much? 2 million minus 1.6. So you lose the gain. $303, $263. $303, $263. Correct. So that is what now they recognize as capital in their financial statements. That is the capital they are placed through that. Which it even makes sense. Don't even reason much. Right now, wewe uko na pesa ukanipatia 2 million. Mimi hiyo 2 million nimeenda nikanunua shamba Kitengela ya 2 million. Right now, after 5 years, then tumesikizana nitakurudishia. I'll return you the 2 million. Actually, they will give it ikiwa 2 million. Si ati watapeana ikiwa 12. They will return that 2 million, but now the purchasing power is the issue. So wewe unipatia 2 million, mimi nikanunua shamba 50 by 100, two of them at 1 million, 1 million. Then you come after 5 years, you want your 5 million. Unafikiria the value of that land will be how much? The way land are changing very fast. I can even dispose that land at 15 million, and I comfortably return to you your 2 million. Alafu wanasema hawa ndio hivi ndio na tana hiyo story. Can remind some people something. So hiyo it's just knowledge ukwe nayo itatusaidia mahali huko mbele. But the main concern of the examiner is on amortization. So right for me as a topic, we have just 1 hour to go. Determination of a bond value. Determination of a bond value during the maturity period. Determination of a bond value during the maturity period. During the maturity period. During the maturity period. You say, this is determined by amortizing the bond. This is determined by amortizing the bond. Amortizing the bond. Having taken into consideration. This is determined by amortizing the bond. Having taken into consideration. Having taken into consideration. Having taken into consideration the finance costs. Having taken into consideration the finance costs. The finance costs and interest paid. And interest paid to the investor. Full stop. Hapo siwezi time. Straight illustration. Straight to the illustration. I want you to go to which setting? 2018. Allow me to start with the 2018. So let's meet in May 2018, question 4A. Amortization, when we do like 2, 3, itakuwa imesync. May 2018, mtu atuambie page, question 4A. May 2018. Question 4A. Page 92, the center. 92, 93. That's what? 92, 93 there. You don't go ahead and put the manual. I think it is this one. So I'm there and I read. It says, E Limited issued a bond, and the one issuing is the borrower, William Akopa. When you issue, you are issuing the certificate so that you receive the cash. When the examiner says they floated, flotation and issuing one and the same. Flotation is related to Gina Serious. E Limited issued a bond for shillings 200 million on 1st January 2018. Interest on the bond is payable in arrears on 31st December each year at the rate of 12% per annum. The bond will be held to maturity and redeemed on 31st of December 2020 for shillings 258.24 million. The effective rate of interest is 20% per annum. The bond has not been designated as at fair value through profit or loss. The bond has not been designated as at fair value through profit or loss. It means, you know, the article classification. If it is not designated at fair value through profit or loss, it means it is designated at fair value through other comprehensive. So other comprehensive is the long term, and the long term is the one which qualifies for amortization. We don't amortize short term. That short term is 1 year. How will you amortize that? So the ones at fair value, those ones you don't amortize, just determine value for 1 year, that is it. So if they say it's not designated at fair value through profit and loss, it means they are designated. Designation is just like classification. They are designated through other comprehensive, and other comprehensive are the long term. The long term are the ones we amortize. Required, we are required to determine the charge to the income statement for each of the 2 years ending 31st December 2018 and 2019. Then extract from the statement of financial position as at 31st December 2018 and 31st December 2019. So for you to determine what goes to P&L and even balance sheet for bonds, kuna 2 questions with epuka bila amortization. 1, bonds. 2, leases. Leases is a topic which we have not covered. So for bonds, we can swali ya bonds and leases. Thinking begins after you have done amortization. So for you to determine what goes to P&L and what goes to the balance sheet, always carry out what we call amortization. So amortize the bond, then you will get all your answers. So right there, let's have a working. You call it bond amortization. Bond amortization. Schedule. Bond amortization schedule. So how do you amortize the bond? This is how you amortize the bond. You say balance brought, no, sorry. You say year or period. You say balance brought down. So the balances, these people are working in millions. So shillings are in millions. Then you increase, you capitalize. You kuna inflation, kuna risk, kuna foreign exchange fluctuation. So you must capitalize the bond. So finance cost is the effective market rate. So the effective rate of interest is 20%. So also students, I want you to know how to separate the 2 rates. I think I've explained back at Melewa, but let me explain it for the last time. We have 2 rates in these questions, all of them. There is the contractual rate and there is the market capitalization rate, which is the effective rate. So the value of the bond should always be increased or capitalized with the finance cost, which is the market rate. Then you reduce it with the actual interest which is being paid. So interest paid. So interest paid, they were to pay interest at the rate of 12% per annum. Then from there, you'll be able to get the closing. So balance carried down like that. So interest should always be constant, this one. The amount paid will be constant throughout. But now market capitalization will always be based on the opening balances. If for the bears and the bulls, market keeps on fluctuating. So for finance cost, we base it on the opening balances. This one, it depends on the opening balance for each year. But interest will be constant throughout the maturity period. Correct. So they issued this in 2018. It will be held up to 2020. So let's proceed up to 2020. So 2019, 2020. So we amortize for the maturity period, which is 3 years. So what I want you to do for me before I start, can you calculate for me 12% on the principal amount? The principal amount which was borrowed was 200 million. So what is 12% of 200 million? %12% of 200 million. Hilda, 24. So this 24 will be constant, and once you pay, you subtract 24, 24. Here, the last year, where it just open a bracket, but don't do anything. Just open a bracket, leave it there. All right. Opening balance is the 200. Finance cost, we increase that value. 20% of this should be 40. So you take 200 plus market capitalization minus the actual interest which has been paid. So how much will be outstanding? 216. Good. So here we will have 216. 20% of 216, what do you get? $43.2. So 216 plus this minus 24. What do you get? You get what, students? 451.2. 451.2. So here we have 451.2. 20% of 451.2. 20% of 451.2. 90.24. 90.24. Now remember, the bond was for 3 years. On the third year, what normally happens, third year wanafaa wa credit account yako wakutumia interest yako kwa account, na pia uende urudishe hiyo certificate wakupatie your principal amount. So the principal, you can redeem, you can mostly, okay, redemption can take 3 phases. You can redeem at par, at a discount, or at a premium, depending with the agreement. But discount, hapana. Discount unless they were giving you exaggerated interest. But in most instances, the redemption, ukinegotiate sana, it can be at a premium. But mostly, redemption is always at par value. So in this question, the examiner was not silent. The examiner said, there's a problem. Inbox. This figure is not correct. Joy, you have misled the congregation. When I say it is true. So what is the figure? The balance is 235.2. Joy, 235.2. Adam, you need 216 plus 43. So 235.2. Then it means the finance cost will also change. The finance cost will also change. Finance cost will be how much? $47.04. Thank you. Alright. So I was saying, rectify that just in case. I was saying, in the last year, you are entitled or you qualify for the interest for that year and also for the redemption. Redemption, you can redeem at par, at a discount, or at a premium. Discount, very rare cases, unless they were paying you exaggerated interest, mnaweza negotiate. But the event there was nothing like that, we normally redeem at par value. Par value is the 200. So here you find yourself redeeming the 200. But in this question, they had agreed to redeem at a premium. The premium was 258.24. So it means in the last year, apart from the annual interest of 24, we will also redeem at a premium of 258.24. Yes. So you will take this plus this minus the entire bracket. So you will get the interest and also you redeem the principal amount. So how much is remaining? How much is remaining? Zero. Yeah, there is nothing. And that's how it should be. But you can get negative. If you put a negative here, it means everything has been paid. But that one comes to nil. So from the amortization, you can answer any question. Any. Like here, they wanted to know the charge to P&L. So you can just say extract of profits of loss. They wanted for 2018 and 2019, those 2 years. So 2018, 2019 financial period. Yeah. So extract means just give us what you can see. So the only expense I can see, so expense is the finance charge. Finance charge, which is the finance cost. So you don't bring interest. Interest is assumed to be part of finance. You know, finance cost is related to me. So this is part of this. So when you have finance cost and interest, you only concentrate on the finance cost. So year one, you will bring 40. Year two, you bring 43.2. Finished. So that is the extract of P&L. Finish that, then we do the extract of the balance sheet. All right, so extract of statement of financial position. So extract of SFP, statement of financial position. So also 2018, 2019. So non-current liability, when you issue, it becomes a loan. So we have 12% bond, which is a financial liability. So you pick the balances carried down, those two. Balance sheet, you check that, you check the closing balances, 216 to 35.2. We are done with that question. And there's something I need to clarify. There are some questions, I hope you are done. There are some questions with zero coupon. When they talk of zero coupon, it means there is no interest, hourly interest, they just capitalize alafu watakulipa hiyo pesa at the end. So, actually, 2015, sifanyi hiyo swali, nawaelezea what to do. There's a question we are going to do. Hii nawaelezea. Check 2015, kidogo tu, tutawaambia which 2015. There's a question. Yes, the question we did, the one for sophistic, part A of it, the September 2015. I want to what to do. September 2015, question 3. The one which was for sophistic. Sophistic was part B. September 2015, question number 3A. Open that question. I want to tell you what you can do with it. Open that question. I hope you are there. So I read, Garvin Limited purchased a zero coupon bond. So when they talk of zero coupon, then here, the interest is zero, this one here. So you have 000 per commission. Zero coupon means there is not hourly interest, they just capitalize. Redeemable in 5 years on 1st January 2014. The effective interest rate is 10%, and the bond is carried at amortized cost. So required valuation of the bond to be reflected in the financial statement 2015 and the finance income. So here, Galvin is the purchaser. You know, the one we have done was the issuer. So purchaser is the investor. The amortization will remain the same. What will change is the wordings. Instead of finance cost, you talk of finance income. Because they purchase the bond. When you purchase the bond, you are the one who will be receiving the benefits. So here you talk of finance income. Instead of interest paid, you talk of interest income, but it is zero. Then balance carried down is just balance carried down. So what will happen with this question? You will just bring the opening balance is the 600, the finance income is the 10%, 0. So it is this plus this, but the closing figures. So you will move with it. Then the last year, the year 5, they never talked of the redemption amount. So you will take this plus this, whatever you get here is what you redeem to get zero balance at the end, the total. So then the valuation of the bond 2015, you will check where 2015 is, then valuation of the bond can pick that figure. Then the finance income for that 2015, you will come from that figure there. So it is easy. This one is easier compared to this because I know interest. So interest is 0. So you just, the figures will be increasing, they will be going up. Then you check that particular financial period. That one you can work out. Let's go to November 2020. Question 5A. November 2020, question 5A. By the way, unajua kuna kitu la kwanza ni psychology kwa hii class. There is this topic called group. People are normally focusing. Hata siku ya group ikifika, utaona sasa kuna watu hata safari hawaendi. This group. The topic itself is wide. It is also challenging and all those things. Then people tend to forget about these small topics. These small topics hata ndio zinaokoa watu kwa mtihani. Group inaweza kupeleka tu wewe unaenda Canada na kupeleka tu Ethiopia. So these small topics, take good care of them. Hapo ndio unapata umescore vizuri. Group hata unaenda unapata 10/20, 8/20, hizi zimekuboost tayari. So take good care of these small topics. Don't overlook them. Now, because in a group, people are serious. The same way. And at that time, one day, you engage your class, LM. Students, the first thing they found my FM or class. LM, nasema hiyo ni theory, we can, that one we can. Hiyo ni kitu ni ngumu. Actually, because I know, when you compare the pass rates countrywide of FR and LM, many students fail LM compared to FR. Ask any teacher. That thing is not a joke. So give these units equal time. Don't overlook at sisi ni watu wa theory. Sasa ukienda kwa mtihani uambiwe principles, principles of management. Is either you know or you don't know. And you can only know them when you attend class properly. You cannot guess. The one you can guess, audit you can dodge around na upite. LM sometimes unaleta kichwa kidogo. So November 2020, question 5A. November 2020, question 5A. From there, I think nimeshafanya hiyo, tunaenda relax sasa. Kutoka hapo tunaenda kufanya ya 2021, then we go to derivatives. Derivatives is part of IFRS 9. So I hope you are there. Tunaenda sijafika hapo. Kazi yangu hapa ni kupiga story. So November 2020, where are you? Question 5A. I should be there by now. And I'm there. And I read. Allow me to read that question. Now, by the way, for information, don't sit here until we are waiting for blocks. Which blocks? Hakuna mambo ya blocks. Unaona ile swali tulifanya ya kwanza, hiyo tulifunza. Hizi zingine sasa ni block revision. So tunapata hakuna kurudi. Tukienda tumeenda hivyo. And that's why I'm insisting not in 1 or 2 questions. Minimum 2, maximum 4 questions to be solved mbele. So that you get the content properly. So hakutakuwa na block. Hakuna hiyo time. Time is the problem. We don't have time. Group inatungojea hapo. Ni refu sana, itatuwestia time. So wewe hizi shika time. On 1st January, allow me to read. On 1st January 2019, Dodoma Limited issued 1 million bonds. Please issued. The word issue is very important. So they are the borrowers. Issued 1 million bonds instrument with a face value of shillings 100. Okay. At a market price of shillings 95. They issued at a discount. The face value was 100. They gave at 95. So they issued the bond at a discount. Bond brokers charge fees totaling 1.8 in relation to the bond issue. The bond carries a coupon rate of 5% and are redeemable in 3 years at a face value. Oh, so they will redeem at face value. Dodoma Limited wishes to account for the bond using the amortized cost method as per IFRS 9 financial instruments. However, there is some confusion about how the bond should be accounted for. There's a lot of confusion. They don't know what to do. The cash received from the bond issue of 95 million is 95 million because they were 1 million, they issued at 95. So they received a total of 95 million, has been recognized as an uncurrent liability. The broker's fee of 1.8 were deducted from the carrying amount of the non-current liability. The coupon payment of 5 million has been expensed in arriving at the profit before tax. Okay. The effective rate of interest is 7.62%. The coupon interest payments are made at the end of the year. Okay. Required demonstrates how the bond issue should be accounted for in the books of Dodoma Limited for the year ended 31st December 2019. 10 marks. Hapo si mchezo. Ukisikia in financial reporting, unaona kitu iko na mahesabu alafu unasikia demonstrate, discuss, illustrate. Hebu nikene kizungu ingine. Discuss, demonstrate, illustrate. Those ones there. Then that question is done in 3 tiers. Tier 1 is to explain. Hata umesikia hapo wanasema there was confusion. So explain what the standard requires through writing. So the demonstration fee computation peke yake or just writing, no. You write the requirement of the standard in any financial reporting. Ukisikia discuss, demonstrate, illustrate, tell us what the standard requires. Do the computation as per what you have said up there on the standard. Then 3, tell us how to recognize it in the financial statements. Because by doing the computation, you are rectifying the mistake which they did or what they did not know how to go about. They now tell us how to, how to work for it in the financial statements. So it is 3 tiers. So let's start by writing. We can write something. So tier 1 is to tell us the requirement of the standard. Tier 2, you tell us the computation based, you give us computation based on what you have talked about in regards to the standard. Then you tell us how to account for it. Then we don't have any problem. So start by saying, under IFRS 9, amortized. Actually, inafai kwa hivi. Under IFRS 9, juni yake, ni hiyo IFRS 9. Under IFRS 9, amortized cost. Under IFRS 9, amortized cost model. Under IFRS 9 cost model, comma, a financial liability should initially be recognized at their fair value. Should initially be recognized at their fair value. At their fair value of the cash received. At their fair value of the cash received. Full stop. Full stop. So that is what the standard requires. That when initial, which I think they did correctly, they recorded 95 as a liability and blah, blah. So the standard requires that initially all financial liabilities, all financial assets should be recognized at their fair value. Let's go to paragraph 2, another paragraph. Any direct costs attributable to the bond issue, should be offset against the carrying amount will be offset against the carrying amount should be offset against the carrying amount of the liability. Offset against the carrying amount of the liability. Full stop. Another paragraph. Therefore, at the initial recognition, the bond should be measured as follows. The bond should be measured as follows. Should be measured as follows. So as follows. So have here shilling. You say consideration of cash received. That is the fair value. They received 95 million. They received 95 million. Less, you walipokea 95 na brokers. Brokers pia walikula, sio walikula ngapi? Brokers walikula, brokers were 1.8. So less issue cost. So issue cost. There was issue cost, which they incurred of 1.8. Now this is the broker's fee. The broker's fees of 1.8 million. So the value of the bond should be that. Because hata wewe wao ndio wanaishi at 95. Wao brokers wamekula 1.8. So the reality in the books, the value of the bond should be less the issue cost. You subtract the issue cost. So this is 93,200. That should be the value of the bond in the financial statements. So they said, hata wao walisema, the broker's fees of 1.8 were deducted from the carrying amount of the non-current liability. That is what they have said. So down there you say, the initial recognition and measurement. The initial recognition and measurement of the liability. The initial recognition and measurement of the liability has been accounted for correctly. Has been accounted for correctly in the books of Dodoma Limited. Hiyo walifanya vizuri at the initial stage. Has been accounted for correctly in the books of Dodoma Limited. Full stop. Full stop. However, tulete however hapo chini. However, IFRS 9 requires that the bond should be amortized. IFRS 9 requires that the bond should be amortized over the bond term, or the bond period. Over the bond term should be amortized over the bond term using the effective market interest rates. Using the effective market interest rates as follows. So you cannot go without amortizing this bond. So as follows. So have bond amortization. So bond amortization. Tunaweza andika hapo schedule. So bond amortization. So here, it was for 3 years, and it was beginning in which year, students? It was 2019. So I'll have 2019, 2020, and 2021. It was for 3 years. Yes. Then balance brought down. Let's reduce those thousands. They are. I wanted to sum the two now in full. Finance cost. So finance cost is at 7.62%. 7.62%. Then interest. So coupon interest. Coupon interest was 5%. Then balance carried down. Like that. So we have to amortize is when we make a conclusion. So I believe you're done. So coupon interest is 5 million. If you check somewhere, but it was 5% based. You know, principal ilikuwa face value of 100. Interest will be calculated on the nominal. Hiyo mambo ya discount hiyo ni biashara yenu. Interest is calculated on the nominal value, which by extension wanawaambia the 5 million. So this one is 5. They were 1 million bonds times face value of 100. Interest is calculated on the nominal. Even if you issue at a discount, that is up to you. Then here they say, so that we start. So amortization, we are going to amortize the 93,200. So unless niende vibaya kwa figures, then mtaniambia, let me calculate so that we don't waste time. So this is 93,200 by 7.62%. You get 7,101,840. Yes, minus 5 million plus 93,200. You get 95,301,840. 95,301,840 times 7.62%. Oh, yeah. Yeah, you put 95,301,840 times 7.62%. You will confirm 7,262. I've just rounded off. So that will be 95,301,840 plus 7,262. Yes, minus 5 million. I'm getting 97,563,840. 97, 563, 840 by 7.62. Get 7, 434, 365. Then here will be 5. How are they redeeming? They must have said how to redeem. The cash received the broker's fee was deducted from the coupon payment has been what else? What did I say? Whichever. If they don't say at face value, yes, rather they say at face value. So face value is 1 million. It is 1 million times the 100, so 100 million. Face value is 100 million. That was the face value. The 1 million times 100, which is 100, yes. So that will be 97, 563, 840 plus 7, 4, 3, 4, 365 minus plus 5 million, that's 105. 105 million, negative 1795, rounding off. So that is nil. It's a very small negative there. That is nil. So you have shown them how to do the amortization. So after showing them, credit liability peke yake, there's nothing else they did. So you need to tell them how to account. So we are not going to do the extracts, but just telling them. So I said 2 tiers. Tier 1 is the requirement of the standard, the computation, then how it should be treated in the books. Okay, you have the same figures. That's the first thing. You have the same figures so that we wrap it up. Yes. So write for them down there. Dodoma Limited. Dodoma Limited. Dodoma Limited. Dodoma Limited should recognize a finance cost. Should recognize a finance cost. Should recognize a finance cost in each year, a finance cost in each year in the statement of profit/loss. A finance cost in each year in the statement of profit/loss, while the amortized cost at the end of each year, the amortized cost at the end of each year should be recognized as a financial liability. Should be recognized as a financial liability. Full stop. Full stop. That is how you should answer such kind of a question. Where would you do? Hakuna swali unaweza fanya bila amortization hizi bonds. But if you hear in exam, in a FAR, discuss, try to play with the standard. Your standard natakanga ni recognize at fair value, then try to do those issue costs, subtract, do amortization, then advise them on what to do. There is a question which if we don't do, my heart will not be at peace, but we are doing in the next class, not now. It's a question which must be done, not made. Hiyo wanafunzi waliflow vibaya sana. December 2021, question 3B. December 2021, question 3B. That is a must done question. So that's the last question we are doing. Then we go to derivatives and embedded derivatives, hedge accounting, and those ones. So we'll pick up from December 2021 questions review. What do you think on what I propose? Oh, mmechoka, are you tired or we just continue? Maybe tunaweza enda mpaka 10. Mmechoka? Ama mko sawa? I was thinking, Mercy already, amesema the idea is very nice. But somebody might be thinking, which idea? My idea was, you don't have, because when we were starting at 5:30, right now we are 2021. When we started to 17 walikuwa kwa class. It means 17 people were capable of waking up. So these 3, maybe they woke up and stima imepotea, mtu bado anatafuta 1, 2, 3. So but Brian is saying it can be difficult for weekdays. So my proposal was, mkiamka hiyo 5:30 twende mpaka 7:30. What would be the problem? Though Brian is saying it will be difficult, but Saturday is okay and even Sunday is okay. On weekdays tunakuwa na classes ngapi? Weekdays ni class moja. So let me try to reason with Brian. Maybe a weekday, because mtu ametoka job late and all that, waking up again very early can be problematic. But if it can work for Saturday and Sunday, then it's okay. So we are trying to salvage time. So Saturday, ile class ya Saturday, let's agree 5:30, 8. 5:30, 8, that is Saturday, then Sunday, 5:30, 9. With that, I assure you, because other nyinyi mmeona tumesonga. You know, I told you we are balancing. We are balancing content and also the time. Yeah, so weekdays, Jacinta, weekdays tumeshatoa. Weekdays tumeshatoa kabisa. Lakini Jacinta, si unakujanga 6:15, sina kuona kama. Jacinta, I want to see you here at 6:15. So how do you survive? Jacinta, allow me to know, how do you survive? Oh, you are 2 Jacintas. So how do you survive?